Welcome to the Red Cloud Research Roundup, hosted by Red Cloud Financial Services. It is November 25th. As we gear up for the end of the year, Managing Director and Head of Equity Research David Talbot is here to look at the current geopolitics of the world as it relates to the uranium sector, the junior mining industry, and the future of the commodity. We have a lot of names to cover in this special episode, so with that, David, take it away.
And thank you for that introduction. Welcome to episode 82 of Red Cloud Securities Research Roundup podcast. I'm David Talbot, Managing Director and Head of Research here at Red Cloud, and I'm pleased to join you today as part of an ongoing series of discussions with the Red Cloud Research team. I'd like to speak to the impact that some of the recent geopolitical events have had on the uranium sector. Escalating conflict in Ukraine and Russia's vocal nuclear posturing has pushed gold and silver prices higher. Oil prices are higher on geopolitical tensions, including that from the Middle East, and base metal prices are higher on reports that China may provide additional stimulus. Advisors in China are recommending that Beijing should maintain an economic growth target of about 5% for next year and push for stronger stimulus to mitigate the impact of expected U.S. tariff hikes on Chinese exports. Uranium prices were briefly higher the week before last on geopolitical news and the aftermath of Trump's election victory, but quickly lost those gains. The recent news about Russia's plans to halt exports of enriched uranium to the USA led to a temporary spike in uranium prices, but it has provided ongoing support for uranium equity prices. While uranium is relatively abundant, there are just a few providers of enriched uranium needed for nuclear power. This situation, while stressful on the U.S. nuclear industry, is positive for the uranium industry, particularly on the back of added demand from AI and big tech, who all seem to be searching for their own power sources. The Trump administration is anticipated to be positive for nuclear power and uranium. Despite his support for fossil fuels, Trump should be highly supportive of nuclear power, not necessarily because it's a clean energy, but because he wants to, quotes, bring Americans the lowest cost energy and electricity on Earth. His Energy Secretary nomination, Christopher Wright, is founder and CEO of oilfield services company Liberty Energy. This attests to Trump's support for fossil fuels and nuclear energy. Wright also sits on the board of a company that makes nuclear fission reactors and recycles uranium from other plants. The Trump election news should already be in the uranium market, but we can expect some volatility in the stocks as the equity markets try to determine which areas will be the focus of the new administration. That said, his administration is expected to significantly impact the U.S. uranium mining industry by promoting domestic production and reducing reliance on foreign uranium supplies. Key impacts may include support for nuclear energy by modernizing the NRC, working to keep existing power plants open and investment in smaller nuclear reactors, increased support for domestic mining, regulatory rollbacks and the streamlining of permitting, focus on energy security, helping reduce the vulnerability of nuclear fuel supply chains. Trump may also influence the global uranium markets by encouraging strategic stockpiling and imposing tariffs or sanctions on foreign competitors. Russia is to halt exports of enriched uranium to the USA. This was the big news from last week, and uranium prices increased $3 immediately, although those gains have been dissipated. The halt of Russian enriched uranium is anticipated to impact the U.S. nuclear sector, which is still getting about 27% of its enrichment services from Russia, while Russia controls about 44% of the global capacity. The prior U.S. decision to halt uranium imports from Russia gradually through 2028 was the precursor to this announcement. But Biden's administration handed out a lot of exemptions that essentially still allowed uranium for any utility that required uranium and had already purchased it from the Russians. Some would even say that the import ban had little teeth, and we didn't see uranium prices rise since it was implemented earlier in the year. However, the Russian uranium enrichment ban enacted by Russia is a much more abrupt action. This could have numerous and immediate impacts on the U.S. uranium industry. Key impacts include supply challenges for utilities. For example, Centrus Energy, it's a major supplier of enriched fuel. They have warned that if other sources are not found, there will be shortfalls starting as soon as 2025. It has received notice from Russian uranium exporter Tenex that Tenex's license to export uranium to the US had been revoked by the Russian government. Dependence on alternatives. The U.S. has minimal domestic enrichment capacity, relying primarily on Urenco in New Mexico, which provides about one-third of all its enrichment requirements. Efforts are underway to expand capacity, but this will take years to achieve. National security and energy strategy concerns. The restrictions highlight the urgency of reducing reliance on foreign sources for critical materials. The U.S. has initiated funding to bolster domestic uranium processing and enrichment infrastructure, with $2.7 billion provided by Biden, but more will be needed. Much of this comes in Biden's Infrastructure Act, but the Trump administration seems to want to halt any unspent funding. That said, a lot of this spending will be in the red states, and it includes nuclear energy spending, so maybe not all of that will be canceled. Market shifts. The Russian enrichment export ban news has led to improved share price performance for many uranium firms, especially those from Canada, Australia, and Africa, as the US will have to pick up pounds from elsewhere. Thus, uranium equities are starting a renewed surge. Ultimately, we do believe that rising uranium prices is the real driver of uranium equities. Surprisingly, besides the recent $3 blip in prices, we haven't seen much movement. Still, $79 a pound is good incentive price in our opinion. By late last week, we had seen many uranium companies up 10% or more week over week, whether producers, developers, or good explorers. There are some grassroots explorers that, as a rule, have not performed well, at least since the AI demand news was all the rage in mid-October, and some grassroots explorers are even off sharply recently. We had expected more from the producers and larger cap uranium companies on the back of this Russian enrichment import ban. While most uranium stocks are running right now, we don't see much of a difference between producers and developers or good explorers right now. Perhaps the developer peer group does have a slight advantage, but that said, the near-term uranium price appreciation should have more immediate impact on producers. UR Energy is up 13% week over week as of late last week, followed by Uranium Energy, Encore Energy, Cameco, and Energy Fuels. We have a buy 1650 target price. We'd also expect Denison to be part of this group, although it was off week over week, or maybe even Paladin to bounce back. African developers have shown strong equity performance as well. The African developer winners were GoviEx, we have a buy 25-cent target price, and that was up 25% week over week. Forces Metals and Aura Energy, we have a buy 65-cent Aussie target. All of those stocks were up 10% at least. Global Atomic, buy 560 target, was up 4%. Athabasca Basin developers of note include NextGen Energy. We have a buy $13 target price, which was up 13%, and Fission, stock is under review, up 8% week over week. Now, we always like to tout the good stories from the Athabasca Basin, and the stocks from this peer group were all up between, let's say, 9 and 20% week over week, at least as of late last week. In order, these include ISO Energy, buy 770 target, Mustang Energy, Sky Harbor, we have a speculative buy, 65-cent target. Atha Energy, buy $1.25 target. F3 Uranium, speculative buy, 60-cent target. And Can-Alaska Uranium, speculative buy. These are the Athabasca names that we speak about most often to clients. Uranium special sits names were up as well, between 4 and 8% each, for Queens Road Capital, Uranium Royalty, Yellowcake, and Sprott Physical Uranium Trust. We do recommend a basket purchase approach to clients. With the market telling us, at least right now, as geopolitical issues are driving the equity markets, it doesn't much matter if you're looking at uranium producers, developers, explorers. But if you are going downstream, investors should best be on the lookout for companies with better stories. Not all grassroots explorers are being treated the same in the market. All of our top picks and favorites are in there. Next Gen Energy, Global Atomic, ISO Energy, Canalaska Uranium. And perhaps throw in F3 Uranium, Atha Energy, Sky Harbor, and Forum Energy Metals into the mix as well. We believe that buying a basket of junior uranium exploration companies is a sound way to reduce risk for investors. Please see Red Cloud's most recent research for a full listing of disclosures for all the companies mentioned in today's podcast, and you can find that on redcloudresearch.com. Well, that is it for this week. We appreciate you joining us, and thank you for supporting Red Cloud's Research Roundup podcast.
Thanks for listening to the Red Cloud Research Roundup podcast, here to provide insightful news on the mining landscape. To access the research reports discussed, explore all of Red Cloud Securities' free research reports, and to subscribe to our email list, you can visit redcloudsecurities.com. That's all for now, and see you next Monday for a new episode of the Research Roundup.